All right, everyone, welcome to Price Action Principles, Trading a Range. So this is Module 1, Market Structure and Fibonacci. So look, thanks everyone for your time. Really appreciate it. You've hopefully by now been through the first PDF, and this is essentially the run through from my end of things just to walk you through it. So that being said, let's crack on. We do have a disclaimer at the front here. Please note that any trades shown in the following content are for educational purposes only. Any risk taken in following trades or setups that are shown for educational purposes is or are entirely borne by you with no assignment of responsibility placed on me, Mindset BTC. I'm not a financial advisor and as such will not provide advice that could be construed as specific in nature. Rather, this advice is intended to be general in nature as an education and entertainment resource. I do not recommend the purchase of any trading pair, investment, ticker, or any other financial instrument that could appreciate or depreciate, and as such will not be held liable for users' investments, both good or bad. Do not blindly follow trading calls by anyone. Instead, do your own research. Past performance is also not a guarantee of future results, and this content is strictly provided for educational and entertainment purposes only. So you've heard me harp on about that a couple of times. Acknowledgement. So there are a couple of people I'd like to acknowledge. Now, I haven't got here on my own. There's a few people that have given me a bit of a kick up the arse along the way, either consciously and directly or indirectly. So I would just like to take some time to acknowledge these people. So the 2017-2018 market, although not a person, it certainly gave me the hunger to learn how to trade after getting my ass kicked. So, same old story. People rocked up last bull run, and yeah, it did probably smash a lot of people in terms of take profits, investing and not really understanding how a market works. But it's a great educational resource is getting your ass kicked. Crypto cred. So your videos and educational content are what set me off down the rabbit hole. So truly thank you for that, or thankful. Trader main. After finding your Discord and observing through your public streams and charts, we had a similar learning experience with trading. Now, I don't know Main personally, but I took a lot from him in terms of dusting off the 2017-18 trading wounds and getting back in the saddle, as we all should do. It's all part and parcel of being a trader. Rect Proof, so a price action legend who focuses on smart money concepts, which is pretty much what we do focus on in this course, but he certainly truly inspired me to take action through his public content and approach to trading. So truly did. A legend of a man, professional to the end, much respect. An Emperor, so no thanks are enough. The man gave me a voice to share my passion of trading and education with you all, and I'm forever grateful and in his debt for this. So thank you, Emperor. And Inner Circle Trader, ICT, some people, you've seen him already on YouTube. He did several mentorships over the years, but I truly regard him as a legend who I've learned many concepts from, many of which are shared in this educational series. Many hundreds, if not thousands of hours spent digesting his material have helped me put this course together for you. A quick intro about myself. Guys, girls, whoever's listening or watching, I'm not a trading guru or god. I'm just a guy with a self-perceived hunger, which I do interpret as being incredible myself, but not from a smartass perspective, but just from a continuously hungry perspective, you can say. So I just wanted to learn all I could about training and to succeed in this field. So the reward and opportunity that space creates and offers is truly amazing in return for the small ask of thousands of hours of charting and learning. Make no mistake, you need to really put your head down if you want to make it. All I did was simply look to find answers for each of the hundreds of problems I faced. And yes, it did cost me money, but the big one was time. If you're time poor, you'll have to put in extra effort or hours. But if you've got lots of money to lose, then yeah, you'll lose it certainly if you don't sort of knuckle down and make a bit of a game plan with trading. So why am I sharing this course? The reason is quite selfish. I like to help people and I do get a kick out of it, so that's a good thing. And presenting a course like this also helps to firmly solidify my own learnings. I do retain much more of my own knowledge when I do utilize it in guiding others like this, so this isn't bad in your case either, and works for me. I'm still learning as well. I'll never stop. So the day that you think you know it all is the day that you're going to get your ass kicked by complacency. So whatever edge you think you have in the market, you'll get rugged. It'll get taken, and don't be a smart ass. Just be a good person. Simple as that. Stay humble. The goal of this course. So why have I made this course? The reason is pretty simple. It's to explore in depth each individual relevant puzzle piece that are, in my opinion, critical in gaining a framework of understanding with regard to price action trading, particularly trading a range. So as a recap, we will be exploring the below in the form of modules released weekly. So the PDF will come out first on a Monday, we'll do a video release midweek, and then we'll do a Q&A session on YouTube or something like that on the weekend. So the first module, this one, is market structure and Fibonacci. The next one is order blocks and breakers, and we also sneak some Fibonacci in that. Third is value area trading and volume profile tools. Fourth is ranges and liquidity targets. Fifth up is trade management. And number 6 is putting it all together. So with that being said, let's get into the course. So here's the agenda, the topics, call it the contents, whatever you want to call it. What is price action? Then we have market structure, so we talk about swing highs and swing lows. Market structure breaks, which are key for what we do in trading, particularly this technique. Then we have bullish / upward trends, bearish, downward trends, bullish reversals, and bearish reversals. Then we do take a detailed look at the Fibonacci tool. So we look at a setup, some background, and execution of these. Then we have potential take profits. So we do a bit of a sweep of how you could play the game. Then we have some self-learning, and finally the conclusion to wrap it up. So what is price action? So from a technical perspective, I will kick it off by asking ourselves what price action is. So my personal interpretation of price action from a technical perspective is that price action, being fractal in nature, is the way that the market unfolds and is established as and after areas of supply and demand are experienced. These tested areas of supply and demand then become formed in actual support and resistance. So these support and resistance levels can then be drilled down further into swing highs and swing lows. I call this market structure. And then we have these swing highs and swing lows in turn that form and become the building blocks that build everything on the micro level, that replicate on a higher time frame and a larger scale on the high macro time frame. So this gives us a big picture from the small end of town to the big end of town, which is the minute chart up to the 2-hour, 4-hour, monthly, whatever. I personally do feel, and I do know, that price is fractal in nature. So what we see on the lower timeframes will certainly replicate on the higher timeframes. So as I've just said, in my opinion, if you can train yourself to recognize market structure on a low time frame, then you'll already have a grasp of these concepts on the higher timeframes. So I do believe these principles work on and in any time frame and market, as a note also. So then we have the Wall Street cheat sheet, as we have all no doubt seen many an influencer share in regard to where we're at in the world. But I also do believe there's an emotional perspective behind trading as well. So what price action is from an emotional perspective, in my opinion, is that it is simply the printout on a chart of every human emotion that is experienced in the market. So we can think disbelief, hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, capitulation, anger, depression, and disbelief. So it goes right through that human emotion, and we've seen it many times. So this chart will replicate to a certain extent from the 1 minute to the monthly and anywhere in between. I do believe this based on the fact that price is fractal in nature, and this is why I feel that price action principles work in any market, because humans are involved, and we as humans are predictable in nature. So based on the above, in my opinion, our job as traders. So I've knocked up this U-Butte fancy pink traders feedback loop, which 1, 2, 3, and 4, they relate directly to over here with this 1 through to 4. So number 1 is to recognize how the dynamics of human emotion play out in the market from a technical and fractal perspective in order to use this to our own advantage. Let's be honest, we are not here to make friends as a trader. You are here for one reason, and it's to make money. Let's not beat around the bush. The friends you make along the way, that's awesome, great. Twitter is fantastic for this, and I put my hand up to say I've met many a good person through trading, but at the end of the day, you are in the market to make money. So in doing so, we must be able to manage our own emotions, and we have to control them. So the way we control them is through a practiced and solid technical understanding of market dynamics, and we continually strive to learn and develop our technical understanding of market dynamics to improve only upon ourselves as traders. When you start trying to compete against Tom, Dick, or Harry, it's going to be a struggle for you. Ignore the 1000% P&L cards. Just stick with what you do. Try and beat yourself every day. Stick to this feedback loop that you'll experience and just go for gold. Stick to yourself. The raw reality of trading. So someone has got to lose in order for you to gain. So for every liquidation or loss, someone else wins. And there are no two ways about it, but trading is a zero-sum game. When you enter your trade on your side of the screen, someone is selling to you on another side of a screen, whether it's a bot, algo, whatever. You just have to be aware that unless you have put in the hours and the effort, you're going to be disadvantaged. So people who get liquidated have no idea on stop losses, or they do have idea on stop losses, but what happens is that their stop losses are lower than their liquidation level, for example. So you have to be critical, you have to be precise, and you have to focus on the detail to build yourself up. So again, this is what the course is really about, is giving you that bottom-up first principles approach so that you do have an understanding of how to trade a range and use price action for yourself in future. So, this is all why we're here, right? So let's get into it. Market structure. So this is the theory part. So market structure can basically be defined as the series of swing highs and swing lows and all the price action in between that can be found in the following scenarios. So we have an uptrend, we have a downtrend, we have ranging price action. So as I've harped on about already, bear in mind that market structure is fractal and can be found replicating itself across all time frames. So the 1 hour, 15, 1 month, 1 minute, whatever. There can be multiple scenarios of market structure occurring across all of these time frames, which you need to be aware of. So for example, the 1 hour chart could be in a downtrend, but the 15-minute chart is showing signs of a bullish uptrend. Swing highs and lows. So these are the key bits of market structure that we need to be very aware of, because this forms the building blocks for market structure breaks, which we do cover next. So a swing high is defined as when price makes a clear high, but is flanked by 2 consecutive lower high candles. So if you look here, you can see that there is a swing high here in this candle, or this candle, sorry, is the top of the swing. This candle on the left, this candle on the right are both lower than that candle, but it does come up and it is accentuated as a swing high. This is also a swing high, but I didn't want to nestle two speech bubbles too close together. And these can also be swing lows, which we'll jump into as well. So while we're here, a swing low is defined as when price makes a clear low, but is flanked by 2 consecutive higher low candles. So there is a candle there, higher on the left, higher on the right. So price doesn't trade beneath this one, which is a swing low. And then you see price run back up to a swing high again. This is a swing low in here, up to swing high, and so on and so forth. Market structure breaks. You've all seen MSBs thrown on charts. You've seen the line. It's cryptic. It's not. It's a market structure break, which in my opinion is where a previous swing high or swing low, which applies to all time frames, is run past, violated, traded above, through, or below to cause a change or shift in trend or market sentiment. So market structure breaks are one of the key components that make up the basis of this course. And we have 2 versions. The bullish market structure break. So a bullish market structure break at a reversal point, for example, price would run up through a previous swing high where we expect retracement back to support prior to price rallying off. And for a trend continuation, we just keep expecting swing highs to be beaten. So we'll have a look in a second. And the opposite is true for bearish market structure. So for bearish market structure break, price would retrace through a previous swing low where we would then expect retracement up to resistance prior to price selling off. So for a bearish market structure break as trend continuation, you will just be expecting to beat swing lows. And we'll take a look now. So here we have an uptrend, a downtrend, and ranging examples. So if we just reference back up here, uptrend, downtrend, ranging, I tried to find the best one I could. And you can see in the green, we're representing that. And what we might actually do is just go across to a chart and have a look at this, which we've got one handy here from earlier. So you can see, as we just blow this guy away, that price trades up. We have a new all-time high. Price trades back down into an area where there is some interest around this order block, which I think was maybe not a bit higher. But then price runs up through, breaks this swing high, which causes a market structure break, which confirms we are certainly uptrending. Now, price comes back down to retest, runs up again, comes back down, and then runs up again. Takes this liquidity, and we come down, and then we break this structure, and then this one as well, which then show us that we are perhaps in a downtrend. High time frame, we could be on a monthly, well and truly smashing it in an uptrend, but as I say, price is fractal. For every high time frame, if you will, there has to be a series of lower or micro uptrends, downtrends, ranging trends that, or ranging environments, I should say, that then contribute to an overall higher time frame. So look, we can see here, you can read this as well, which is in the PDF, but you come down to the ranging area and you do have some market structure breaks, but they're not clean and clear. Remember, we looked at when a trend changes and you need to see a run up, back down for a retracement, and when that other swing high is run through again and then retested, that's when we consider that a trend has occurred, a trend change has occurred, sorry. And then you can see here again in the green, and then red for an uptrend and downtrend, followed by another uptrend, bit of a range, and then we come back down, which I believe was where we blew through an all-time high 69. Yep, that's it. That's the first part for you there. So we will get rid of that one now, and we'll jump back into the course. All right, so we've just went through that. So the red parallel channels represent downtrends, green represent up, blue is a ranging area, and so on and so forth. Here's an uptrend for you. So we have a swing high, it comes down, retests whatever support is here, runs up, back through, then comes back down again for a run through. So you can see that this is consecutive in an uptrend, that we're just beating swing highs. And here's an example. So as shown on the chart on the right, you can see how swing high market structure is continually beaten in the form of an uptrend, or to form an uptrend. So each successive swing high is broken and price continues upwards in a very strong fashion, as you can see here. And we'll go and take another look at that on our charts. Let's have a look. And here we go. Just got to get rid of that guy. You can see here, so we have a ranging environment in this area, which was a semi-downtrend, but then market structure is broken. Price runs up, retests at an area of interest, which over here looks like a bearish breaker of some sort, bullish breaker, beg your pardon, and runs up and through for another ranging series, and then consistently beats market structure to continue a strong trend. So you can see we're heading upwards, no doubt about it, but you can see that without swing highs and swing lows and market structure breaks, then it's hard to obviously identify where we are with the trend. Sorry, just bear with me. Then we have a downtrend, so where each peak and trough is successively lower than the previous occurrences. So we see price coming down for a retest of resistance, breaks the swing low, comes up, same thing again, and you can see that we're in a consistent downtrend. And you can see on the bearish downtrend here on the chart that price, we have a consistent swing lows being broken, and each successive swing low is broken, meaning price is in a clear downtrend. And we'll go and take a look at that one now as well. And get rid of this guy. And we'll just have a look down here, which is the downtrend. Sorry, there we go. Too many things open. But yeah, you can see that a swing low is broken here. Price runs down, ranges for a little while on the daily here, and then price breaks a market structure again, comes back up for a retest, and then blows through, and we are close to where we are at the moment with our current price. So that is really the premise for you. You always want to be looking for these swing lows to be beaten, broken, and so on and so forth. All right. And we'll just get rid of that guy there, and we'll get back to our course. There we are. So bullish trend reversal. So this is where we have both of what we've just learned in the form of a downtrend, which then turns to an uptrend. So you'll have a swing low, comes down and through, and then you'll have a swing low, which is usually quite deep, which is typically a run on liquidity where stops are nestled, and then you have price that runs up through, retests some support, and then breaks through, and that's when it's confirmed to be a trend change. So you can see here we've got a bullish reversal and some dialogue on that, but we also have this example here. So you can see that as price downtrends, so we have lower highs and lower lows, and you can see that on both fronts here. Then we have an area of interest reach / liquidity run on low, which you can see here that the lows are swept, where once liquidity is nabbed, price runs up, breaks this previous structure here for a swing high to be broken with a market structure break, and then price comes down, retests an order block in this area, runs back up through, retests again, and then shoots off, and that's how quickly it can happen. So you can see in this image here, same sort of thing, up, down, deep retracement, up, which you can see here. Up, down, up, deep retracement, and then we continue following the new trend. So a bearish trend reversal, same thing but in reverse. So again, trading doesn't really have to be that tricky, and if you are struggling, I do suggest that you can invert your chart. So that's helped me out heaps in the past, that you might not necessarily see something that really helps you on paper here. We'll actually just go and take a look at this because we are expecting to have a look at that one. Get rid of this guy here, and that's a bullish trend reversal here. So now look at this. If we just right click, invert scale, you can see that this image here, swing high, which is deep, then we lose that support, and then we retest as resistance and then roll through. You can see that here. So price comes up, runs through. We have a deep run up, which bear in mind this is inverted. Price comes back down, breaks that structure, and then sets us up for a trend change, and off it goes. So you can see that there's a few tricks up your sleeve, and if you find that you prefer bullish setups, or sorry, bearish setups, but you struggle to see them forming, then just invert your chart and have a look. So there's no right or wrong in trading, and that has certainly helped me out many a time. So all I can say is don't be shy. And this was the one that we were looking at, which was our bearish trend reversal. So this is the same one here, and you can actually see that price is in an uptrend overall, and then we have the high swept, and price reacts after breaking through the market structure to come up for a retest, and then we start to see an ongoing area until we find some key support where supply outweighs the people selling off. So the demand overcomes the supply, I should say, sorry, and then price runs up and off. And yeah, we'll just go and have a look back at our course, and you can see that here as well. So up, 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 and then you find the support resistance flip, which you can see in this area here. So price comes back up and then finds that as resistance rather than support. That's the picture we just looked at. And the next one is the Fibonacci tool. So as this course is all about building the component understandings of how to trade a range, it's only logical that we explore how to set up a specific type of Fibonacci to then utilize on the market structure that we've just covered. So what I didn't want to do is confuse anyone without covering the bases and the foundation layer of what exactly we're ranking the Fib tool to otherwise. So the way I personally trade sees me using two setups with the Fibonacci tool to justify my trade entries. And these are a range-based setup, which we cover in a later module, and the entry fibs, which are covered here. I would like to clarify that these are ICT's fib systems in a circle trader. Again, check the acknowledgements at the start of the module. I'm not one to try and claim credit where it's not due, and the man is an absolute mind-blowing trader. So if you like what I provide to you, then certainly go check him out. Rightio, so the entry fib setup. So if you go and check up here on your trading view chart and you click on the third run down and you hit fib retracement, you'll be welcomed to a Fibonacci. Now, this is our range-based setup, which we're not covering in this specific example, but we'll just open up that one, which is the classic range. Classic as I call it. And if you check settings, then you can see that here's the style, the figures I use, and then the background levels, and so on and so forth, which you can see quite clearly here, which I've done. And you wouldn't believe how much time this type of thing takes to make, but here we go. You've got it nice and easy as a cheat sheet. So just read through this area and you can see that I have no background. I don't select reversal or price options. And then I have levels selected with labels on the right, but they're in the middle. It's my preference. You may like it the other way. If something doesn't work for you in trading, just change it up. You'll be surprised at the slightest thing that you can actually change that really works much better for you. Like we just talked about, the inverted chart gimmick. Maybe you have a different setup for fibs. Completely your call. Next slide. We've got the entry fib background. So I don't, as I've mentioned, typically have these colors used in my fibs by any means, but I've just done it here so we can reference back to colors as we are showing them on the chart as we're using them. So I will read through this. So we'll delve into the background of the fibs. As you can see, there's the full suite of fibs in colored boxes. And these can be broken down per the below. So the anchor levels, these are the key levels. So 1 in the light orange and teal are the 0. So you would pull, and you'll have a look in a minute, you'll pull from a swing low, in this case for bullish, to a swing high, and we'd expect price to retrace to the 618.702 or 786 for a run back up. So you can see that the trade entry levels of the 0.618, 0.702, and 0.786 live in this area here in yellow as I'm showing it. You may ask in terms of why the 702, if you simply take 618 from 786 and meet in the middle, that is the 702 level. There's nothing sinister or magical behind it. It's just a mid-range point. So then we have the target levels of the 0.28, 0, negative 0.27, and negative 0.618, and then the negative 1. So if you have a look at this with the fib levels, they are percentages of a move. So we have got these in decimal form here, but you will notice that you have an option for percentages, which 1 would be 100, 0 would be 0%, and if price fell back down from this level, you would find that This level, for example, is a 70.2 retracement from the 0 level, and so on and so forth. So the entry fibs, the anchor levels. So the anchor fib levels form the backbone of every setup that you establish using this particular fib tool. In terms of how we utilize the anchor levels, we do the following. So at a swing low if bullish or a swing high if bearish, this is where we anchor the 1 level. And at a swing high if bullish or a swing low if bearish, we place the 0 level. So in doing so, the rest of your levels will fall into suit as they are auto-placed by the tool. So you just worry about 1 and 0, and the rest of these get auto-populated for you. Simple. You've got a bearish fib setup here, which is the same but inverted, and I just want to make it easy for everyone to see. So the entry fibs, our anchor levels. So this is the bullish example, and we can go and check in a minute, but you can see here I've highlighted the orange, which shows down here the orange, and the teal where we're looking for the 0. Pardon these, the numbers on this side was a bit squished, but I think it's better rather than having on the left where it's a bit harder to see. But anyway, you can see where I've highlighted in a red circle here for a swing low, and then the swing high up there, which your retracement falls to the 618 level. And you would get a potential trade there if you were aiming for the 0, but you'll see as we talk about target levels in a minute, they don't always get hit. So here's a bearish example. Again, I just wanted to make it clear for everyone with both scenarios, because you should be comfortable trading both sides of the market with buying and selling. And you can see we have the 1 in orange, and you have the 0 in teal here with entry points showing where to anchor your fibs to. Then we have the entry levels. So these are, who would have guessed it, where you enter your trade. So in terms of how you utilize the entry fibs, after you've pulled an anchor level to determine your fib setup, we then expect that price could retrace to these levels. Now we're saying could because this isn't a foolproof method. We do need to see other forms of confluence before entry, so don't just think that these will save the day or your bacon, because they don't. So my advice is to set an alert before these levels are hit. Check that your trading plan still makes sense with regard to how the market looks compared to when you thought initially when you thought that your trade idea could play out. So we'll talk about that in module 5, which is your trade management, which will include a trade plan, which is pretty straightforward, but it may be a bit mind-blowing at the start if you're a new trader and you have no idea what to do. So here's an example: entry fibs, entry levels, bullish example, swing low, swing highs we've talked about, and then we have our entry in this area, which then sees price run off. Then we have the entry fibs for a bearish example: swing high, swing low, entry potentially made. You can see a couple of options here and setups that do show their way. And I'm pretty sure and certain that these actually did play out. So let's just go and have a look at that, because it was on Ethereum, but we have here that was not there. I will come back to that anyway. I'll mark myself up. But yeah, this is the optimal trade entry zone, as ICT calls it. So you can go on again, check his content out on YouTube as well. So the target levels. So the target levels are where I personally do take profits at and over the course of a trade. So to be clear, this is determined by my trading plan that can be unique or uniform depending on how the market's looking to me. So you can say that sometimes you might have a target of simply the 0 level once the price has fallen back into this area. Or you may say, look, I want to hit the 0.28, 0, the -2.7, -618, and -1 as a whole and sold trade. So the 0.28 level, this is the inverse of the 618 level of a counter move, which we'll explore shortly. So the 0 level is the swing high that we're actually anchoring on for our retracement to come down to. So this can be a partial profit take or a whole profit take. It's completely up to you. And then the 0.27 is the same ratio as a 0 to 0.28. You can see here they are evenly spaced, except for that, obviously we're one figure off, but that's really to front run anyone else who's trying to aim for that area. There's the equal -2.8. Then we have the -618, which again is the same sort of thing, so equidistant. And then we have the 1. So this is, as Inner Circle Trader calls it, if price reaches this level from a 1 up to a swing high, retracement, and then runs back up, that is a measured move. So that's a 200% extension from this level. Because if the 1 to 0 is 100%, remember, and the 0 to 1 is another 100%. So it's a 200% move overall. So here's your entry fibs example. with being bullish. So you can see the multicolored Technicolor Dreamcoat that we've knocked up here. But remember, folks, that I don't personally use this for my fibs. It's just to help you guys out. So again, disclaimer, these targets won't always work. You need to manage your trade accordingly. So don't go whinging back to me. Go and work it out for yourself. Play around with these and you'll see what works and doesn't. Coupled with the profit taking that we'll explore shortly, you'll be able to see that you can have some wins and also continue to be profitable if you aren't already doing so. And here's the bearish example as well. So you can see that we aim for a swing high here to a swing low, and these are the colored options that will pop up. Bear in mind that the colors obviously won't be there, but you get my drift. Again, these targets won't always work. Just manage your trade accordingly, and take responsibility for your own actions. So we do have an entry-level counter trade target. So this is a bit of information for you. So there is a certain relationship that has a clear impact from a counter trade target perspective when using the entry fib system. So the relationship revolves around two key levels, the 0.28 level versus the 0.618 level in terms of moves in opposite directions. So in the below slide, you'll see chart 1 here, and the trader 1 in chart 1 pulls a swing high to a swing low and expects an entry in the entry level area. Trader 2 here on chart 2 pulls a swing low to a swing high and expects to enter at the entry level fibs. If trader 1 in chart 1 had got short and entered here, and he was aiming, or she or they were aiming for the 0, for example, or even below further, and trader 2 here was actually looking to enter along because they felt the market was moving that position, you'll see right here with this fantastic looking danger kind of image or whatever you want to call it, you can see here the interaction. So let's try and zoom in. 618, 702, 786 versus 0.28 level. So there is some interaction. Be careful, be wary of it, because as we say here, if there is enough buying pressure at these entry levels in favor of the trader in chart 2, then the trader in chart 1 may be in a bit of trouble. So, i.e. price could run back up and get them. Potential take profits. So I do get asked very often and a lot of the time where to take profits. So let's have a look at a bit of an example that certainly did help me and continues to help me as a trader. So we have covered a bit of ground. So we've had the logical understanding of market structure, to then using the Fib tool on said market structure, to now using the Fib tool as an indicative area to take profits at. I did want to keep this as sequentially logical as possible for everyone, so there was no point in jumping to potential take profits if we hadn't covered fibs, if we hadn't covered swing highs, if we hadn't covered market structure. So you can get where I'm going. And this is, again, the premise of the course in my mind, is to try and start you at ground zero and work your way up with this knowledge and framework that will help you as a trader. So when you're trading this method, or any method, if you're using Fibonacci, a suggested take profit regime is per the below. So you do have to work out what's best for you in terms of comfortability and what your level of experience is. So for example, we could have a take profit 1 at the 0.28 level, maybe 10% of the position size. Then perhaps a take profit 2 at the 0 level, maybe you could take off 25% of position size. Note though, so after take profit 2 is hit, I will usually bring my stop loss to break even. I am firmly of the belief in protecting my capital at all costs, so I'm not interested in full moves without locking profits in. This is the way I genuinely play it, and anyone who wants to counterplay that or whinge or perhaps suggest that's not right, that's cool. I rightfully respect where you're coming from, but this is the way I play it. And it's not right, it's not wrong, but it certainly does lock in profits, especially if you're a new trader looking to protect your capital at all costs. Right, so take profit 3 could be at the -2.7 level, maybe 20% of position size. And then same as take profit 4 at the -618, again 20. And then you have two options here at the end. So take profit 5 at the -1 level, 25% of position size, or you can have a theoretical take profit 6, which you could let run from your final take profit with a trailing stop loss for the full effective move, or you could simply just let it run and manage it manually. Every time you have another fib extension run up, which you can add and include into your fib setup if you are bold enough and savvy enough to do that, and then you can just trail it for the full effect of a move. Be very observant of one thing here. So note how with the above, there aren't any hopes and dreams. It's a structured, logical approach. Again, some may not agree with this. There's a lot of people that say, why would you bring your stop loss to break even? Trader Dante loves to use the CUN beep word to describe people who do bring the stop loss to break even. But in this case, let's be realistic. You're looking to learn how to trade. It helps lock in profits. And this only happens after you've taken 2 sets of profit. So essentially, take profit 1 is 10% and take profit 2 is 25%. You've just locked in 35% of your position size in terms of profit, and then you bring your stop loss to break even. But again, play around with it. You'll see, you perhaps will get a bit cocky or a bit lucky, or you'll just want to be a bit anxious. Again, it's all about controlling your emotions. But if you do bring your stop loss to break even, you watch. Murphy's Law, as we like to say in Australia and perhaps elsewhere in the world, will show you that you'll get stopped out, and then price will run back down to your original target. So look, you'll learn to love it, you'll learn to hate it. But again, guys, it's a suggestion from a purely educational and entertainment-based course. So potential take profit levels, a bullish setup. You've got this in your course. I do want to just check this out on our, that was our take profit area. Let's get rid of this guy here. Counter target trends. We have some potential take profits. This is the bearish version, and this is the bullish version. So we'll come back to the bearish in a second, and here we go. That is our trend change as well. So we need to get rid of that guy. Beg your pardon. Where is he? There it is. You wouldn't believe the amount of time to try and get these set up and stored. And you can see on the right here, there's plenty of different items from the different lessons that I'm doing. So yeah, lots of fun in the future. So again, look, if we go and actually do this from a physical perspective together, you can see that you pull a fib from a swing low to a swing high at this point. And sorry, you can't see that. Let's just get that out of the way, and we'll actually grab this guy and bring him up here. All right, so you can see that if we had entered our trade from the 1 to the 0, we ran for our retracement. That's absolutely spot on and beautiful. And then you see all these fibs that are staring you in the face. Now, as soon as price runs up here, you can actually take profit. And then same for here at the, as we talked about, the 0 level, 25% of position size perhaps, and your stop loss gets brought up to break even. Now you'll see that you actually will achieve the full extent of this, this run, which is amazing. Now, if we actually looked at what this kind of looked like, you could see that if you put your stop loss down the bottom and you did aim for that full extension, then fantastic, that's a 5.28, but it's not really, because you have taken profits and you've reduced your position size as you go. And I don't have the workings for it here, but this would probably be something like a 3R, 3 risk to reward, if you rather than a 5.29, which I'm happy any day of the week to take profits and bring my stop loss to break even and then catch these moves. I'd rather 3R than have nothing, or 3R and get stopped, etc. So that's that one. And then we have the profits for, just get rid of this guy. We have the profits down here for a bearish scenario. We just have to find them again. Which they are right here. And you can see, again, this was the, I think this was the area we looked at earlier, but here we go. So you do have some possible and suggested take profit positions. And you can see that if you had pulled a fib from a swing high to a swing low, that's fantastic. You get one stab and then you get another stab here. And then price well and truly again runs down. So that's magic. It's good. That's 2 good examples there. So if you want it to be quite risk friendly, you can put your stop loss right there, or go 2 swing lows back. And again, if you were to aim for a full suite here, you'd have a 4.06. If you were to be a bit riskier, you could see that you can have a 5.53. But again, you'll probably end up with a 3R here if you do take these sequential profits. So 10% at 0.28, 25% at 0. If you so wish, bring your stop loss to break even, and then you have a 20%, 20%, 25%. And hopefully they all add up to 100. So please, anyone, give me a bollocking in the comments if they don't. Now, what have we got next? So this is the bearish setup, as you do have, and it's just the one we looked at then. So you have this in your PDF. And we now move on to self-learning. So this is pretty much the wrap on lesson 1, module 1, however you want to call it. But now that we've completed the module, just go ahead and practice identifying where and how a few things do form. So trends form up and down, market structure and how it breaks and how it forms, and the reaction of the market after these and after reversals, and during a trend and continuation. So really spend a bit of time hammering home for yourself with regard to how the market reacts after market structure breaks. Again, these are probably the backbone with Fibonacci in terms of how all this works. So you just need to be aware of how they do form and how they're sort of rolling on in trading. Again, we have reversals from a bullish and bearish form and perspective. We also have an idea now of how ranges occur, although we haven't delved in it too much, but for now, we'll get to that in module 4. And then we have Fibonacci Tool, our setup and our execution, and then we have some potential take profit areas. Again, with the take profit, just note, it's a suggestion. So if it works for you, that's fantastic, awesome. If it doesn't, that's cool. Leave some feedback or work out what works best for you. It's as simple as that. In the next module, though, we will be covering how order blocks, OBs as I call them, come into the mix. And once we've built a level of understanding around OBs, we will then use the Fib tool again to adopt a trading entry method that complements this understanding, which really is what we've covered here, but it just goes into a little bit of further detail. So conclusion. This concludes our initial foray into the component parts that for me make up each and every part of trading a range. So this obviously upstairs from what you've just seen in this whole PDF/video, whichever one you're watching or reading, it's a bit of information to digest. So hence the reason why the course is delivered weekly. So it's that we can get a PDF, or I can get a PDF out to you for a bit of theory, and then we can talk about it on a Wednesday, and then let's do a bit of a shooting of the proverbial on a Sunday or something like that, or a Saturday. But I'll think about how we can do that. That's on YouTube or something like that. So again, each of these, this isn't, we're not robots, so let's not pretend that each one of these items has to specifically be used in trading a range. You can use any of these items that we explore and share in any of your trading. So not only is this a trading the range course based on price action, but it's also giving you some techniques and arsenal, weapons out of your arsenal for trading price action concepts. So again, the end goal of this course is to explore in depth each individual relevant structure that are, in my opinion, critical in gaining a framework of understanding with regard to price action trading, particularly trading a range. Now, the reason I did this was because when I first started trading, I had no idea where to look or what to look for. And I've got to thank RecProof again, because he really did inspire me based on what he put out there. That really framed it for me, where I learned a lot from Inner Circle Trader. So yeah, look, all I can say is ask questions, bug people, and if you don't know the answer, you're either going to spend a lot of time working on it or money learning from it. So take both, not as disadvantages, but learning experiences. Journal your trades, which we will cover as well. And the following suite of modules are coming up. We've got market structure, which we've just done. We have order blocks and breakers, and we'll sneak Fibonacci in there as well. And we also have value area trading and volume profile tools, ranges and liquidity targets, trade management, and then we explore putting it all together. So that's it for me. I'm almost sick of my own voice after 42 minutes. I can't believe that. So yeah, thanks for sticking around. Remember to stay hungry. Say hi to the old chook for me. And that's me signing off from this one. Thank you very much, guys. And chat to you soon.